Hi, my name is Jordan Wilson. Today we're going to take a look at compound returns. And I want to look at them mainly because in our investor profile analysis, we saw how time has a huge impact on your financial objectives. And it's also a huge constraint on achieving those objectives. The more time you have, the easier it is to assume volatility, to adjust midstream to meet your goals. And the less time that you have becomes very problematic because you can only increase the risk in your portfolio or increase your funding contributions in order to catch up. You can't really go back in time. So today, compound returns. And what we want to accomplish here today is look at what is a simple return. Conversely, what is a compound return? How do they differ from simple returns? What are the keys to effectively managing compound returns? And then we'll finish up with an example to sort of bring everything together. Simple returns. We covered that already in our look at investment returns. Essentially, they're nominal returns. It's the return that you receive from an investment. Maybe that's interest income, dividends, capital gains. But it's a simple return because it's paid out to you, and then you spend it or do whatever you want with it, but it's not reinvested directly in the portfolio. If we look at a simple example, say you're working in a warehouse, maybe an Amazon warehouse, where you're paid $100 for each box that you assemble during a day. And let's say that you can assemble 20 boxes per day. By Friday evening, that's 100 boxes, you receive $1,000. That's the simple return. Compound returns are like simple returns, but here you actually reinvest the income. The income, in turn, begins to earn income of its own. And that income on the income begins to earn income itself, and so on and so on and so on. If we go back to the warehouse, day one, you assemble 20 boxes. Day two, you come in, you have your 20 boxes, and you start working on your own. But you look over and you notice that those boxes are beginning to assemble their own boxes. At the end of the day, with your 20 boxes, you suddenly find that there's 3 additional that the boxes from the day before have made themselves. As we roll around a Friday evening, instead of 100 boxes, you have 135, and you receive $1,350 instead of the $1,000. Now, unless we're in the world of Harry Potter, we probably don't see magical boxes appear that assemble their own. But if we go to investing, in some ways it's very much like the magical boxes. So compound return investment lessons. The first lesson would be that the longer the time period that you have, the greater the impact on the compounding. Again, we see time crucial for compounding. Taking another simple example, but a financial one this time, you have a $1,000 bond. It earns 10% interest per year, and we're compounding annually, and we'll start compounding at the start of the year. In 10 years, that bond will be worth $2,594. Of that, $1,000 will be the initial principal, $1,000 will be the simple interest. $1,000 at 10% is $100, 10 years, $1,000. And then the difference between the value and we backed out the initial principal and the simple interest is the interest on the interest, the reinvestment income. And that's, in this case, after 10 years, $594. Almost half of the actual interest on the bond itself. If we look at 25 years out, the bond, and again, we're just assuming the bonds are trading at par and we're not having discounts or premiums, but the bond is trading at $10,835. Now we see the simple interest is $2,500, 25 years at 10%, but the compound interest has grown to $73.35. It's almost 3 times the size of the simple interest. And that's our box analogy. We're creating the 10% return ourselves, but then the return, the boxes, are building their own boxes. And after 25 years, that's quite a substantial increase. If we go at 50 years, we see now that the simple interest is $5,000, 50 years at 10% for a $1,000 bond. But here, the compound interest is actually $111,000. Huge. And if we see the value of the bond is $117,000, that means that the accumulated compound interest is almost entirely the value of the bond. So the longer the time period, the greater the impact. Similar but different, the farther out the time period, the greater the impact. If we continue with our example, the 10-year time period for the bond gave us $25.94. If we look at the 11th year, so 1 year farther out, the bond value is now $28.53. That's an increase in compound interest of $159. If we go out 26 years, again, we see $10,835 versus $11,918. Just that one extra year from year 25 to 26 brought us almost $1,000 increase in compound interest. That's the initial principle of the bond itself, just 1 year of interest. And if we compare the 51st year to the 50th, we see an $11,639 increase. That's 11 times the invested principal. So the farther out the time period itself, the greater the delta, the variance, the increase over the previous year. The higher the return, the greater the impact. We saw that when we looked at investor constraints in the investor profile section. If you juggle the return rates, you'll get different increases in value, which is obvious. So here we have a 10% bond. What if we increase the return rate to 11%? Over 10 years, we see that we have almost a 10% increase in the total return. That's not bad. But if we go out 50 years, that increased return is 57%. So 184,565 versus 117,391. That's a lot of increase just for 1% added return. Now, the opposite, unfortunately, is true. What if we reduce the interest rate to 8.5%? And here's a real world example to keep in mind. You go in and you buy an actively managed mutual fund, a bond fund in this case. And they're going to charge you 150 basis points, 1.5%. If you're in Canada, that's probably a reasonable fee for an actively managed fund. Canadian mutual funds are quite highly charged as far as management fees go. So if the fund itself is returning the 10%, but they're taking a 1.5% management fee, you only net 8.5. What's 1.5% amongst friends? But in this case, over 10 years, that costs you $333. Okay, maybe manageable, but you only invested $1,000. Less manageable. Over 50 years, the reduced rate of return after we back out the management fee, suddenly we only end up with $59,000 instead of $117,000. That 1.5% actually cost us $58,000. So the fee will compound, but not for you. It'll compound for the mutual fund company, for your advisor, whoever's taking that annual fee. Another lesson is that the more compounding periods you have in 1 year, the greater the impact. You can think of this like a home mortgage in reverse. So if you have a mortgage, you probably know that the more payments that I make in a year, the faster the principal on the loan falls. And that's true even if the aggregate value of the payments is the same. So if I'm paying once a year $24,000, that will have a certain impact on reducing the principal, because a lot of that money will actually just go to the interest component of the debt. If I make 12 payments a year of $2,000, it's still $24,000, but that will have bigger impact on reducing the principal outstanding. And if I make 52 payments per year weekly, still the 24 grand, but divided by 52, that will also enhance the reduction in the principal. If we look at it from the compound return side, we take our original example, a $1,000 bond, 10% interest rate. On an annual basis, we saw that after 10 years, the value will grow to $2,594. But on a monthly basis, that same bond will grow to $2,707 after 10 years. On a daily basis, $2,718. Not huge growth, but every dollar counts, especially when you're not contributing anymore. And we see after 50 years, that annual compounding grows to $117,000. But when you get to a daily, $148,000. That's a significant difference with no change in funding. Just the compound works for you. Another lesson is that the lower the costs, the greater the impact. Management fees, sales commissions, taxes, transaction costs. Anything that reduces your return or reduces the amount of capital to invest hurts your compound ability. We saw that on the previous slide where we assumed that the management fee on a bond fund was 1.5%. And we saw the huge impact over time that relatively small percentage hurt growth. The idea is that you want dollars paid out to be focused on the investment itself, not paid to others so that they can grow on their behalf. You want your money working for you, not helping someone else grow their own cash. If we look at it from a tax side, 30% tax rate on income. Above, we saw that after 10 years, without a tax impact, you get $2,594. With tax, you're down to $1,967. Over 50 years, and this is a scary one, you go from $117,000 with no tax all the way down to $29,000 with tax. Now, if that's not an argument to use tax-deferred investment accounts in Canada, the RRSP, I don't know what is. Let's look at a pseudo real-life example of how those keys to compound return play out in real life. With apologies to Aesop, we'll call this the ant and the grasshopper. Twins, 25 years old, both starting new jobs. But the ant, she's more industrious. She's looking to the future. So she decides, I'm going to invest $300 monthly. And because she knows a little bit about compound returns, she realizes the impact that taxes have on her portfolio. So she sets up a tax-deferred registered retirement savings plan. She looks around, decides on a nice balanced portfolio fund that will earn 8%. Its expected return over time will be 8%, and that's net after management fees and administrative costs and all that. So she goes off, invests her $300 monthly. At age 40, she's contributed $54,000 into the RRSP. But because of accumulation and income and reinvestment of income, the balance is now $104,000. Not a bad return. At age 40, though, the ant decides to get married, decides to set up a different pension plan with her husband, and stops making contributions into this specific plan. It sits there for the next 30 years, and she finally terminates it at age 70. And she's a little bit surprised to find that it's now worth over $1 million. No contributions for the last 30 years. It started at age 40 at $105,000, $104,000. And it's grown almost tenfold with no further contributions. Impressive. Now her brother, at age 25, he's enjoying his job, but he also likes the good life. He likes to travel to Hawaii. He likes to have the nice cars. So he's not really saving anything and hasn't set up any retirement plans. At age 40, he's kind of matured. He notices how well his sister has done. He looks out and says, I've got 30 years to invest. Plenty of time to catch up. She's only invested 15 years. Lots of time for me. In fact, since she stopped investing or stopped contributing, I probably don't even have to invest $300 a month to catch her. So he goes, sits down with a financial advisor, says, I want to invest in the same fund that she is in, earning 8% net per year. And he's expecting, okay, I'll probably have to put in $250 a month to catch her. He's a little bit shocked to learn that he's actually going to have to invest $750 monthly for the next 30 years if he wishes to catch her. And because of that, total contributions are going to be $270,000. Just by waiting 15 years before beginning to invest, he has to invest twice as much per month. And over the 30 years, he's going to invest $270,000, whereas the ant only invested $54,000. But at age 70, they'll end up at the same place. So that's kind of the real life version of the lessons. And the moral of the story, begin investing as soon as you can. The longer the time frame you have, the better off you'll be. And even relatively small amounts can accumulate over time. And you'll find that pays off because the sooner you start, the less in total you need to contribute. Ant contributed $54,000, but she started earlier. Grasshopper, $270,000. 5 times the amount to reach the same end value, all because he waited 15 years. Focus on net returns, not just gross. So if someone's telling you it's a 10% fund, look at the after-tax and the after management fees and other expenses return. The key is you want money that you invest or you pay out of your genes to work on your behalf, not on the behalf of a fund company or a bank or some other financial institution. Every dollar that you contribute should go to building your wealth, not someone else's or taxes. So very important. That's all on compound returns. Hopefully you see better the relationship between time, between return, and between funding. And I think it's very important to consider compound returns in your lives. And because of that, you should always try to utilize tax-deferred or tax-free investment accounts. And in Canada, given the annual contribution limits, I think for most retail investors, those are the only 2 accounts that you need, the TFSA, which is tax-free, or the RRSP, which is tax-deferred. Most retail investors, because of the annual limits on contributions, will probably be fine with just those 2 accounts going forward. And then if you want to get into things like registered education savings plans, if you have children, those sort of things as well can add value. So thanks for your time today, and we'll talk to you at the next episode.